Hi students. So in yesterday's class we were discussing about the difference between primary market and secondary market, in which we have discussed that primary markets where the companies or organizations first time issues shares to general public for the purpose of raising funds. So secondary market where already subscribed shares are bought and sold. So secondary market provides liquidity to the investors. So primary market is the place where investors can park their money and organizations can raise long-term funds. So that's what we have discussed in yesterday's class. Now we already discussed about money market and money market instruments, where we have discussed that we have explained that money market is the market where short-term funds are borrowed and lent. Short-term in the sense within a year the entire transaction takes place. Now, capital market is meant for long-term debentures, issuing of equity shares. That means these shares and debentures are redeemed or repaid after 1 year, after 10 years, after 20 years, 25 or 30 years. That means pretty long period when compared to money market. So this is the basic difference between money market and capital market. So money market is the place where short-term funds are borrowed and lent. Capital market is the place where funds are dealt for longer period when compared to money market. So this is the difference between money market and capital market. So for SEM examination purpose, this concept is very important. Difference between money market and capital market. And from next session onwards, we will discuss capital market instruments. So please note down all these points, and these points are quite easy to understand. I'm going aside so that you can see the green board and you can make a note of all the points. So things to remember is money market is the market for short-term funds. Short-term in the sense within a year. Within within a year is we reframed or we renamed it as short term. So within a year, the funds borrowed and lent, funds borrowed should be repaid and funds lent to be received within a year. So money market is the marketplace where money is dealt for short period and for within a year. And capital market, when compared to money market, is the market for medium, in the sense more than a year and within 5 years, and long term, that is beyond 5 years. So, capital market always deals for long term funds, deals with long term funds. Now, working capital, money market, the fund borrowed from money market or by issuing money market instruments where fund is raised is used for working capital. Working capital is large context and even in earlier class also I have described what is working capital is. I have defined what is working capital. So working capital is nothing but fund required to run your day-to-day activities. So the fund raised from money market or fund raised through issuing money market instrument is mainly used for working capital requirements. And working capital plays a very prominent role in any type of business, in any nature of business and any scale of business, large scale, small scale, medium scale. Working capital plays the primary role. So if you have transportation business and the fund required to fill your fuel for your trucks, that fund is called working capital. So that means the fund required to run your day-to-day activities of the business is called as working capital. So fund raised from money market instrument is mainly used for working capital needs, and the capital market fund raised from capital market or fund raised by issuing shares or fund raised from debentures, that is long term debt, is mainly used for acquiring fixed assets. So it is considered as capital funds. Fine. So fixed assets are funded by capital market funds, and working capital, you know the formula. Working capital means current assets minus current liabilities. So all the current assets are related to working capital, and fixed assets are acquired by issuing long-term funds or raised by long-term funds that comes under capital market. Now, the small amounts of when compared to capital market funds issued, funds raised, or instruments are being issued are quite less. So that means the small amount of funds are raised in money market, and if you compare to the capital market, the funds raised are pretty quite large amount. Because if you need 100 crores, then you issue shares. So entire 100 crores, 10,000 crores, billions of dollars cannot be raised by issuing mere money market instruments. So you have to enter into capital market for large amount. So that is the major difference between these two. Usually the amount or volume of fund being raised is quite lesser or quite smaller when compared to capital market. So that's why if you keep your deposit for longer period, the interest offered by bank is quite low. And if you finance for short-term period, you charge more interest rates. That's what I have mentioned here. So interest rates charged in money market is usually high, generally high when you compare it to the capital market. Right? So the interest rates are generally low in capital market because under capital market long-term loans are lent. So long-term deposits are made. So that's why interest rate when you compare it to the money market, interest rate is quite high in money market and interest rates generally low in capital markets. So it acts as an intermediary between depositors and borrowers. See, money market talks about depositors and borrowers, and capital market talks about investors and commercial and industrial entities. So we will discuss what depositing and what investing activities are. So depositing, you merely deposit in bank. Investing, you invest in certain companies, you invest in certain commercial entities, you invest in certain industries, you invest in certain sector like software, uh, you invest in mining companies, you invest in automobile companies. But when you talk about the deposit, you deposit your money in bank. So that's what the difference is. So money market always deals with depositors and borrowers. Capital market always deals with investors and industries. You need to remember this point. And it helps in sustainability of economic development of a country. So money market instruments plays for sustainability of economic condition of the country, whereas capital market it gradually helps in increasing the volume of economic activities in a country. That's why it considered as it accelerates economic development. So capital market instruments and funds raised from capital market because if you raise a fund, you're going to start something huge, some new project. So you have to hire people, you employing people, you pay salary to them, they again spend it for some other purposes. Economy accelerates with the help of capital market funds, right? So it sustainability of a country's economic condition can be done with the help of money market instrument. So it measures financial health. So money market, the volume of money market, the size of the money market helps in measuring the financial health of the country. That's what I have described earlier as sustainability of economic condition. And capital market helps in measuring economic growth. So growth in terms of GDP, growth in terms of per capita income, growth in terms of national income. So all these things are related to capital market and funds raised by capital market. And the fund raised from money market is used for day-to-day transaction. Day-to-day transaction in the sense same as working capital. So the money market instruments or money borrowed under money market is used for your day-to-day transaction of the business, as well as money borrowed or shares are being issued under capital market is for conducting long-term projects or financing long-term projects. That's why you use these funds from capital market to acquire fixed asset. So when you talk about liquidity, the liquidity is high here. Liquidity is quite higher in money market because the borrowing, if I borrow 10,000 rupees under money market, I have to pay them back within a week, within a month, within a year. That's why liquidity is quite higher. So capital market, if I issue shares to general public, I raise fund. So I no need to pay them back within a year. Likewise, if I borrow long-term debt from a bank, I never, the term of the loan is for 25 years. The liquidity is quite less because I repay my loan after 10 years, 15 years. So liquidity is less under capital. So these are the difference you have to remember for your SEM exam purpose also. The difference between money market and capital market. So in next class, very important, we are going to discuss capital market instruments. Under that, we discuss equity shares, we discuss preference shares, we discuss debentures, mortgage loan, what do you mean by pledge, etc. What do you mean by mortgage and pledge, etc., etc. So thank you.